market, see, as you yourself mentioned, I think while everyone has expectations and anticipations from the budget, but unless there is something very substantial in nature that affects, the cash flows in a meaningful manner of the company's longer term, the market would move just intraday on the day of the budget, and then that event would be behind us. So unless there are major changes on corporate taxes, for example, like the positive ones that were announced in September of 2019. So any such major change is because it impacts directly the cash flows of the companies in future. Otherwise, I don't think that there is any material expectation built into the market that the market would be disappointed if not delivered upon. Obviously, we
Prashant,
as individuals have our expectations.
Prashant, the market has actually been in a kind of a sell-off slash profit-taking mode last 3 4 days, which is completely understandable. But this is the second quarter, in a row when the numbers actually have been higher than estimate. We are seeing that numbers are coming out pretty well. Do you think markets have baked in a recovery in earnings for next 2 3 4 quarters?
So let me just first of all tell you, Ajay, as you very well know, the high on BSE 500 was 19,200 and today it's 18,541. So it's roughly 650 off the top, so barely 3% plus. But I guess we are all spoiled over the
Sure.
last 9 months with a unidirectional upward sloping market that even a 3% sounds like a sell-off. So, to your question of whether the earnings are baked in, yes, see, market being a discounting mechanism, it recognized well ahead of any of market participants or macro gurus or fund managers that the pandemic isn't going to have a lasting impact on company or corporate cash flows. And hence, well before the worries about COVID had settled or far from settled, the market began its upward journey. So, market is expecting or factoring in that the economy would have a very sharp rebound, which already it has, but continue to have a sharp rebound. This year might be down high single digit or so for the economy. Next year, expectations are for double digit economic growth. Corporate earnings are not turning out to be as bad as were expected. Third quarter earnings are, in fact, coming out to be very strong. And year to date, or for the year now, most expectations are for high single digit or double digit earnings growth. Imagine with the economy down high single digits, still corporate world is expected to deliver almost double digit earnings growth. And on top of that, next year, expectations are for another 25+% earnings growth. We can
Right.
delve how and why the earnings are so strong, but the market is expecting building in some of those expectations at the current market levels or during the whole of last year as market regained its lost ground.
Right. Prashant, how are your companies, the portfolio companies that you have, how are they really coping with this recovery? Because on the one hand, the earnings outlook has improved and demand outlook has improved. On the other hand, raw material issues have cropped up like never before, uh, input price pressures, etc. What are the kind of conversations you're having with your portfolio companies?
Certainly. So one has to really look at sector by sector. If you look at the major sectors, let's start with IT services as an example. They're seeing very strong demand trends from around the world. One thing that every company and any company that is worth its name has realized during the pandemic is that technology is very core to businesses, any kind of business, and they must have now post-pandemic preparation for a dual or a parallel network that allows work to be conducted as normal business as usual from home as well. So that has entailed tremendous ramp up or acceleration of technology spend worldwide, and that is certainly benefiting Indian IT services companies because they're in the midst of all these multi-year, multi-decade trends which are getting accelerated now. So I'm sure you have seen the performance and the numbers because most of the IT services, since they report early, are already out. And despite Q3, December quarter being a seasonally weak quarter due to furloughs and whatnot, these companies have shown amongst the best QOQ trends in a long time. So that's on IT services. In banking, which is the other very large sector, the numbers that have been reported so far, and some of the private banks that one reported yesterday, one of them reported a few weeks ago. Again, you're seeing very solid. While the NPA numbers are artificially suppressed right now because of the NPA directive from RBI, which where the NPAs are not recognized. But even if you look at on a pro forma basis, just imagine that a year ago, or about 9, 10 months ago, there were serious question marks about survival of a lot of financial services companies, including some of the largest banks. People were started talking about who will be the last man standing. So for the financial sector of the country to come through the worst possible crisis of our lifetime, right, with more or less unscathed, I would say, in comparison, in contrast to the magnitude of the crisis that the pandemic has unleashed, I would say a minor bump in NPLs from 1% to 2% and credit costs of similar magnitude is nothing. It shows the robustness of the model and how well
Sure.
managed companies and banks are. So their numbers have been far ahead of expectations just a few months ago. These are two major sectors, and consumer sector, be it paints companies or consumer durables, they're showing very strong growth. And it is not just pent up demand. Pent up demand is part of the mix, part of
Sure.
the demand driver. But beyond that, I think there are other factors like the underlying economy in rural areas as well as urban areas that's picked up very well. That is contributing to the shift from unorganized to organized. That's been a multi-year phenomenon, further
Sure.
accelerate. Those are
So,
contributing
no,
factors.
you're right, Prashant. Let me come in over there. Just barely 1 to 2% of the loan book, total loan book, were actually likely to get affected due to COVID, whereas the fear was it could be as high as 8 to 9%. You're right in mentioning that. And probably that's why the top banking names are relatively much more resilient now. And people are wanting to buy them on the dips. Let's talk about consumer. You have a big weight there in your portfolio. You understand that space. Over there, Asian Paints today is talking of requirement to raise prices. On the other hand, there is a new incumbent on the arena which is wanting to challenge the big shot of decades. So there's a flurry of activity. How do you see all of that without talking of stocks? But how do you see pricing ability of the leader as well as the challenger?
Certainly. No, it's very interesting. And obviously, to stay away from talking about any specific stock, but if we talk about the paint sector in general,
Yeah,
uh, dynamics of the sector are quite attractive. It's from a growth perspective, it's a structurally growing segment of the economy. Uh, Besides the demand growth, you also have a element of unorganized to organized sector move, and the structure of the economy with about four players, major players in the organized sector. It is well behaved in terms of pricing and competitive environment overall. And it is in India, paints, unlike most parts of the world where paints don't have such an emotional connect with consumer. In India, there is one, and hence it is a brand. People do value brands in paints quite substantially. As to new entry, I think, see, if done right, it is possible that considerable headway can be made by a new entrant who does it well. But it is something that one has to have the patience and commitment to pursue for many years. And it is possible that given the announcement that is indeed in place, I don't see a major upheaval that would destroy the fundamentals or profitability of the sector anytime over the next 3 to 5 years or even longer term. It will be one new player. It remains to be seen how the industry adjusts from 4 to 5 players, or other players who might come in. But you cannot, at this point, do either. You cannot write off the new competitor, nor can you assign a very high probability of success either. You have to wait and watch how this unfolds over the coming few years.
Prashant, you're a very unique practitioner of money management in India because you've worn many hats. You've been an FII, then a PMS, and now also turning into how your friends from the FII community, dollops of liquidity which is coming in, what's the outlook? Do you see we'll be beneficiary of foreign fund flows for a reasonable period of time? What are the kind of conversations you're having in your own backyard there with friends in Singapore?
Certainly, Ajay. I would say, look, the market levels and the market direction and the trends are the primary drivers of flows. Everywhere in the world, that is a omnipresent truth. Even in India, if markets remain elevated and continue to move higher, you would see eventually the flows turn positive and turn into a torrent. And offshore as well, the concerns were very high during mid-year June July timeframe, May June July timeframe, the migrant crisis and India's poor healthcare system and how we would handle those and all those have been put to rest, and the market put those concerns to rest before the actual reality, and hence the sentiment also starts turning globally for investors. So as long as the market remains directionally in a positive mood, I don't see the appetite subsiding or appetite disappearing amongst foreign investors. Of late, what we have seen is increased interest from foreign investors who had at some point in time over the last couple or 3 years, in a way, stopped or paused looking at India as an individual country for investment destination. They were invested in India, but through GEM Fund or Asia Fund, and weren't that keen on a country dedicated allocation. Now we are seeing increased appetite amongst those investors to have India as a specific country dedicated allocation, which is a very positive and heartening sign.
Mhm. Prashant, how are you analyzing the asset management space here in India? Not only from an analyst perspective or a money manager, because there are listed entities and entities which capture that business in listed space, but also from somebody who's interested in expanding that business. Because there is a tailwind to that asset class now, and there are the millennials and the new generation is interested in this asset class. What are your thoughts there?
No, certainly, I would say the opportunity is very large and very long tail. We are in very early innings, if I may say, in our infancy or childhood days in terms of development of the industry. This is an industry where all those figures are very public, where in Western countries like US and Europe, this is a centuries old industry, very well penetrated, very large number of players. There are thousands of players in some of these countries. And over time, India is also bound to have increasing penetration of mutual funds and many more players who would be participating in that. We are hopeful with regulatory approvals. Upon regulatory approvals, we also look forward to offering our services to retail investors like we are able to do elsewhere in the world. We recently got a similar retail license in Singapore that allows us to offer our products and services to investors globally.
No, that's interesting. Congratulations on that. Uh, you've also been started to communicate with your client community in a differentiated manner. You've started writing your own memo of sorts. Up till now, we've been reading memos of big investors globally. So, how does it feel to translate your thought process and framework into writing? And what's the key message which you're telling your investor community about your thought process right now?
So I'm sure you're referring to the newsletter or a vantage point that was just released shortly. It was my first letter, if you will. So I'm a very slow writer, but clients have been at us for long and asking us to pen down our thoughts. So we thought of starting it this year because 2020, I believe, exemplified some of the learnings that we've long believed in, particularly as it pertains to the futility of macro for predicting market behavior over time. And as you know, the pandemic hit 2020 was the best example of that. A year ago, around this time, we'd be talking about whether GDP would be 5% or 6%, whether interest rates, were there were room for further reduction, whether the fiscal situation is going to improve, what about the NBFC crisis, and so on. Now, on every one of these parameters, the reality turned out to be much worse than the worst expectations, and still we had a better than average year, a very robust year in the market. So, what that shows is all these are worries, these general worries are very futile in terms of their power to predict market behavior. And on major events like the pandemic, nobody has a crystal ball. And even if one had a crystal ball and was assured of all the events that were to take place going forward, still they would not have been able to predict the market behavior. Imagine a year ago, if we were told this is how the pandemic would play out, we would all feel that it would be the worst year for Indian markets in history, probably worse than GFC. Right. So, despite having perfect prior knowledge in these matters, it's impossible to predict the market. And
Prashant, yeah, go ahead.
the worst thing that investors, the worst mistake in my many decades of investing, what I've learned is the worst thing to do is to base your investing actions on the back of your such macro worries.
Okay, Prashant, you've also seen several booms and busts and how the market factors in the recovery ahead and then the recovery pans out. But by then, bulk of the gains in the market have already been made and then normalization happens. Even if we are structurally moving higher and the case for expansion of the market is higher, does it appear that right now we are in the same stage where even though next 2 3 year roadmap or probability of expansion is there, but the rate of return should moderate and ideally investors should adjust towards that?
I think from here on, it's reasonable to expect more reasonable returns from the market. I would say in the low double digits. But what you said is very true, that it takes a lot longer for investors to adjust to reality than the market does. Market does it a lot ahead of actual reality, whereas investors make the mistake of correlating what they are seeing in the actual economy and what the near term forecasts of macro gurus might be. They try to correlate it with the market of the day. And hence, in April, May, June timeframe, when the COVID cases were ramping up and the country was under a lockdown and the economic growth was minus 24%, people were scratching their heads at the dichotomy of of an economy that is down 24% and a market that's up 25% or something like that. That is because market always looks a lot far ahead, and market doesn't need to see the bottom in the economy. Market doesn't even need to know for a sure where and how deep is the bottom. At the first sense or hunch that it is not a bottomless pit, the market starts to recover. And oftentimes by the often it is the case that by the time investors realize and macro experts realize where the bottom is, the market has recovered all its losses and some more, as it
Okay,
happened in 2009 and as has happened again in 2020.
Prashant, your thoughts on some of the risks which also lie ahead, because the returns may not be linear from here on, and it'll take a lot of research and all sorts of factors required to create alpha. Talk to us about some of the risks which exist on the table, which investors should be cognizant of while making their investing hypothesis.
No, certainly. So see, there are these, well-known risks, what we say, and there's these unknown risks. So there's this risk that how the pandemic from here would evolve. The general expectation, which we subscribe to as well, expectation is that the vaccines would be rolled out around the world, and by the end of the year, majority of the world would be vaccinated, and then the virus would be, relegated to a one of those flus which might not be eradicated, but vast majority of the population and every year would be vaccinated against that. Now, if there are any variants that develop which are beyond the effectiveness or efficacy of the vaccination, then that remains an uncertainty still to be a low probability, but still an uncertainty to bear in mind. Besides that, I think more from a structural perspective, the only risk, and I'm not saying that that's going to happen, as many other macro experts are saying that there is high risk of inflation going up. I don't necessarily agree with that viewpoint, but yes, that remains a uncertainty or a risk if inflation expectations were to move higher. Not necessarily inflation this year or next year, but the long term inflation expectations are what are more important, because if those were to move higher, then that could lead to bond yields rising around the world, which can then put some pressure on equity market multiples around the world.